Hello, everybody. My name is Michel Perera. I've had a career in financial markets, most recently as Chief Investment Officer, and I am very thrilled to be taking part in the Wealth Transformation Summit. Now, why should we talk about geopolitics? I think it's because most investors don't understand geopolitics well. It seems to be a catch-all term which is bandied about to signify that there's additional risks out there, meaning that you should be more careful with your portfolio. But it's only when you start going into the details that you realize that this attitude won't improve your investment returns and may actually even reduce them. So there is the opportunity to debunk a lot of myths. What is the difference between geopolitics and simple political events? What makes a difference is when there is an event that shatters all our expectations and moves the world. If a new leader is elected or appointed in a country, chances are it won't make a big difference. If one country invades another, it probably will, although it depends on which country. If Mali invades Burkina Faso, it probably won't make a huge difference. But when Russia invaded Ukraine, it made a huge difference. And people are talking about China potentially invading Taiwan. So it's a question of the importance of the countries involved, also a question of degree and duration of the crisis. Now, what is the boundary between geopolitics and domestic politics, and why does it matter? Well, it matters because in most democratic countries, domestic politics is unlikely to move markets much, except perhaps for the impact of taxes and spending. But there's many other factors that override that in the long term. So you then look at what is geopolitics and what importance it has had for the markets. And that's the important point. No matter how much people worry about geopolitics, if you look at history, the events that really caused investors to lose a large amount of money in history were the two world wars and also the nationalizations and expropriations, like Russia after the revolution in 1917 or China in 1949. Most other geopolitical events only had a short-term impact on markets, including September the 11th, including most of the things that happened during the Cold War. Now, of course, that begs the question, if world wars move the markets and you can lose a lot of money, is there any current event which is likely to lead to World War III? Well, it's anybody's guess. But being permanently afraid of such an outcome will generally mean missing out on most investment opportunities. In fact, anybody can do a very simple probability analysis with your own assumptions. If you say, if you think that there is, say, a 10% chance of World War III starting in the next 5 years, and all markets will fall by 50%, then you should also calculate the returns you could get if the other 90% probability happens, and then you can decide if your sacrifice is worth it, i.e., if selling assets in order to avoid World War III is worth it. Obviously, the shorter the time period during which you're going to be short of investments, for instance, by owning a put on the market, the lower the cost to you. So if you can narrow it down to 6 months rather than 5 years, it will be much more cost effective. But then you have to be much more accurate in your timing. Besides, if we're talking about World War III, if a nuke is coming your way, the last thing you're going to worry about is your pension. Can you forecast geopolitics? Is there any chance you can get it right? Honestly, you really can't forecast these events, and trying to do it is generally a waste of effort. Markets didn't get the Russian invasion of Ukraine, even though the CIA had been warning about it. Nobody foresaw September the 11th, the Israel-Gaza conflict. Often the reaction in the markets doesn't last very long. For instance, Brent oil price is now roughly where it was before the Ukraine invasion. So let's look at what the markets are currently pricing in terms of geopolitics. The problem is they're pricing what is called known unknowns. If everybody's talking about something, such as the Chinese invasion of Taiwan, or the risk of a direct war between Israel and Iran over Gaza, then it's at least partly in the market price. But how about the unknown unknowns? Donald Rumsfeld, who was Foreign Secretary to George W. Bush, made the crucial distinction between known unknowns and unknown unknowns. It's the latter that can really move markets, but trying to forecast it, unfortunately, is like shooting in the dark. So, since you can't forecast the events themselves, which areas of the markets are going to be influenced by geopolitics? Of course, it's well known that anything happening in the Middle East tends to boost the oil price. But these movements generally reverse themselves quite soon, and they actually matter less to the economy today than they did in the 1970s or the 1980s. Oil is not that important for the world economy anymore. On the other hand, if China were to invade Taiwan, then the semiconductor business would be in severe turmoil. The price of chips would soar, and customers of chip manufacturers would plummet or go bankrupt. Given how important semis are to the whole economy, it would have a domino effect throughout the world, much more than the oil price. So that's why people today are focusing on what is actually a low probability event, China invading Taiwan, because it could cause gigantic disruption globally, as well as, of course, the risk of bringing the US into a war with China. One other part of the markets that also is sometimes affected by geopolitics is gold. Does it reflect geopolitical risks? There's an aspect to that, and quite a lot of people say, oh, I'm going to buy gold because I expect some tension somewhere in the world. But there are many other factors that move the gold price. There's simply central banks needing to park huge trade surpluses and diversify their currencies at the same time. So they can't put everything into US dollars or even euros. Also recently, gold has acted as an alternative investment for disgruntled Chinese investors who don't like what's happening in their market. So, having talked about geopolitics, what about domestic politics? Does it matter as well and as much? Some domestic stocks are sensitive to policy changes in their countries. For instance, sectors like housing, lending, retail. These sectors, or even some specific stocks within these sectors, tend to move with opinion polls ahead of the next election. For instance, in the US, there are Trump stocks and there are Biden stocks. Given the uncertainty on new governments, which government's going to come in, what majority they're going to have, what leeway they're going to have, and the laws they're going to pass, as opposed to what they're campaigning on, forecasting such possible changes is often no help when you're a fundamental equity analyst. Having said that, I don't want to sound like you can totally dismiss domestic politics or geopolitics. It was definitely possible to trade profitably in 2016 ahead of the UK referendum. You just needed to bet on Leave against the whole of the market, which was on Remain. And then you would have made money on currencies, on domestic shares, on international equities. But that's a very rare example of how you can make money forecasting political events. And of course, you have to be right. Is there any mileage in trying to forecast election results, and hence the possible application of a party's manifesto or program? In the UK, for instance, we may now have, the first Labour government in a very long time. But quite rightly, they are unlikely to show all their colors right away. So betting on huge changes might be ill-advised. Also, there is nothing like the backdrop we saw in 1997, cool Britannia, etc. to the upcoming election, and Keir Starmer is unlikely to do something as momentous for the markets as giving independence to the Bank of England, which was one of the first things that Tony Blair and Gordon Brown did when they came into power. Now, what about the US election in November? Is it likely to move US markets? Well, Biden is in favor of raising corporate taxes and Trump in favor of cutting them, or at least extending the 2017 tax cuts. Trump is threatening 10% tariffs on all imports across the board, and even 60% on Chinese imports. These are huge numbers. Regulations are also likely to be very different under Biden or Trump, with particularly antitrust legislation at the forefront. By and large, if Trump can be persuaded not to go for higher tariffs, then Wall Street would probably prefer a Trump win. But that's a very big if, because it looks like he really means it. Now, there are other factors in politics. People talk about taxes. Oh my God, they're going to raise my taxes. Well, are changes in personal taxes an issue that investors should consider when deciding on their portfolio? Basically, it means, should you let the tax tail wag the investment dog? For an individual, taxes may matter a lot, but for the markets as a whole, tax changes are unlikely to override any fundamental movement in economic sectors. So you should be a bit careful about it. And don't forget, whereas individuals are taxed on their investments, there's a huge percentage of investors out there who are not affected by taxes. ISAs, SIPs, pension funds, hedge funds, etc. And they do most of the trading. Now, the last question that some people have asked is, I have a strong view on politics. I believe that this should happen and this should be done, etc. Should I reflect that in my portfolio? Well, there's a difference between trying to have expectations about what's going to happen and inserting your own political bias into your portfolio, because the end result of adding your biases to your portfolio would be some sort of double counting. In particular, if these views apply to the country that you live in and pay taxes in. If you are bullish or bearish about politics in your country, this is likely to be reflected in your daily life. So changing your portfolio would only double that effect. And if you're wrong, you'd be compounding your losses. Now, if you look at outside of your home country, biases can be dangerous because you'll have less information, you'll have limited information compared to your home country. Should you bet for Trump or Biden to win, and why, as an investor? Is China uninvestable because of its policies and political system? Is Europe bad to invest in because of the EU? These are biases that people have and which may affect a small part of the risk-return parameters in these regions, but they'll ignore everything else. So you have to be very careful about adding these biases to your portfolio. So finally, in conclusion, what should we look at as investors? We need to have reliable data, analysis, and research in order for us to invest. Where do you get that from? You get that information from companies, from economies, economic data, and from markets. Other factors tend to be flimsy. Things like the weather, the environment, politics, human development, and they're generally not as well researched and not as foreseeable. If I want to take the politics element to an extreme, every time you look at a list of the happiest countries in the world, Finland comes on top. Does it mean you should be overweight Finnish equities all the time? Now, come on.